All right, aspirants, if you're gearing up for banking exams, you know that RBI directives are pure gold. Today, we're going to break down one of the most critical documents out there, the official rulebook that dictates how every single bank in India has to set its interest rates. So, have you ever wondered how they actually land on that number? It's definitely not just pulled out of thin air. It's a really detailed system, all laid out by the RBI, and getting a handle on it is absolutely key for your exams. So yeah, let's get right into it and decode this thing. We're going to follow the official structure, chapter by chapter. We'll start with the legal foundations, then move into how benchmarks have evolved over time, and wrap up with the most important takeaways you need to have locked in for exam day. First up, let's get the ground rules straight. Where does the RBI even get the authority to do this? And what are the key terms you're going to hear again and again? The very first thing to nail down is that these are not just suggestions or best practices. No, they are legally binding directions. The RBI has the power to issue them under the Banking Regulation Act, and that's a foundational fact you gotta know. Okay, so what's a benchmark rate? Think of it as the starting line. It's the base price, the anchor that everything else is built on. Every loan's interest rate starts here. A floating rate loan is pretty much what it sounds like, right? The interest rate isn't fixed, it's not locked in, it moves, it floats, changing whenever that benchmark rate changes. And that's exactly why these RBI rules are so important, to make sure that whole process is fair and totally transparent. Now here's a technical term that can trip people up. Rests. It sounds weird, but it just means how often interest is calculated and charged to you. And for almost all loans in India, the rule is monthly rests. It just creates a standard playing field for everyone. Okay, now that we've got the lingo down, let's zoom out and see how these pieces fit into the bigger picture. The high-level framework that every single bank has to follow. No exceptions. These right here are the non-negotiables. A bank needs a policy approved by its board, and every floating rate loan must be tied to a benchmark. But the golden rule, the one I really want you to see highlighted there, is that a bank can never lend money for less than that benchmark rate. That's a huge deal. And here we are, at the absolute heart of this whole topic. This isn't just a list of regulations, it's a story. It's the story of how lending benchmarks have changed over time in India. And trust me, understanding this journey is key to understanding the RBI's entire philosophy. This timeline tells you everything. You can see a very clear pattern. The RBI has been on a mission, pushing banks away from these internal benchmarks that they used to set themselves, like BPLR and MCLR, and moving them towards external ones. And the big question is, why? Well, the goal is simple. To make sure that when the RBI changes its policy, that change actually gets passed on to you, the consumer, as quickly as possible. So, before we get to the current system, you absolutely must know the 4 components of MCLR. This was the big one from 2016 to 2019. Think of these as the 4 official ingredients that went into the MCLR recipe. You gotta know them for the exam. So let's zoom in on that first component, the marginal cost of funds. The directive's own data reveals something pretty fascinating. This cost is overwhelmingly driven by just one thing, the bank's own cost of borrowing. It makes up a massive 92% of the total. So why did we make this big shift away from internal benchmarks like MCLR? Well, it really all boils down to 2 things, speed and transparency. With an external benchmark that's tied directly to the RBI's repo rate, any policy changes get passed on to borrowers almost instantly. There's no more waiting for the bank's internal, kind of opaque calculations to catch up. So the benchmark is the base. We've established that. But how do we get from that base to the final interest rate that you actually pay on a loan? Well, that's where the bank's own components come into play. The formula is actually pretty straightforward. Your final rate is simply the benchmark plus something called a spread. Now, this spread is the bank's layer. It covers their operating costs, their profit margin, and a premium that's based on your specific credit risk. And you've got to pay close attention to the reset frequency. With the older MCLR system, your interest rate might only change once a year, but under the current external benchmark system, it must be reset at least once every 3 months. This is a huge deal because it keeps your loan much more in sync with what's actually happening in the economy right now. All right, now for the fine print, because, these rules don't apply to every single loan out there. So let's quickly run through the key exemptions and then talk about a major amendment that's just come on the scene.
This right here is classic exam question territory. You'll notice a pattern with these exemptions. A lot of them are for very specific situations like government schemes or internal loans that a bank gives to its own staff or its own depositors. These just operate under a slightly different set of rules. Okay, so until very recently, the rule was crystal clear. It used the word shall. Now, in legal terms, shall is a command. It means something is mandatory. Banks had to give borrowers the option to switch to a fixed rate during a reset. It wasn't their choice.
And here it is. This is the game-changing 2025 amendment. One word changes everything. Shall becomes may. This is a massive shift. It basically takes a right away from the borrower and turns it into the bank's choice. Offering that switch to a fixed rate is now completely at the bank's discretion. Okay, we've covered a ton of ground. Let's distill all of that down into a final high-yield summary. These are the absolute must-knows for your revision. Let's do a quick fire round. The legal basis is sections 21 and 35A. The current system, external benchmark, mandatory since late 2019. You've got to know MCLR's 4 components. Remember the faster reset for the external benchmark. And above all, do not forget that recent, huge shift from the mandatory shall to the discretionary may. This slide is your cheat sheet.
And that's our breakdown of the RBI's interest rate rulebook. As you continue to prepare, keep this final question in the back of your mind. What does this recent shift in power really mean for the relationship between banks and borrowers? Because understanding the rules is one thing, but understanding the real-world impact, well, that's everything. Good luck.